Good morning, Richard Calhoun, Creekside Realty, 40 years here in Silicon Valley working with buyers and sellers. We're here today to talk about the market conditions, so we'll jump right into it. This graph is showing you the dark blue line is available inventory. One of the things that I've learned is out of the three MLSs, they all have different levels of inventory, which is why I was having some confusion. You would think the inventory is pretty fixed. So I'm now using my definition. My definition is single family homes and condos and townhouses in Santa Clara County, but not in a few outlying areas. The few outlying areas are like the La Honda area where there's a couple listings. Condos, I'm listing some areas in San Mateo County. Santa Clara County is 100% included. San Mateo County has a few small pockets. That allows me to compare what I've been doing since 1997. Since there's not agreement on what is and is not inventory, I figured consistency is more important. So what you can see now is look at the blue line. The trend is actually becoming pretty apparent. We had way more inventory at the beginning part of the year when everybody was complaining about the lack of inventory. Then we were normal for a long time, and now we've dumped down and we're about 80% of the normal level of inventory. So we are finally having less inventory than you would expect. The other issue related to inventory is the number of new listings. This is the amount of inventory coming onto the marketplace, and that's the gray line. And you can see that it fluctuates quite a bit from week to week. This one big spike is because that corresponds with Memorial Day that we just had. And typically it's before the 31st. The 31st is when it was this year, so it was as late as it possibly could be. So the week before Memorial Day, you had a lot more inventory coming on the marketplace. And then Memorial Day on again, it was back to normal. So it was just a shift in the calendar. The other side of supply and demand is the red line, the rust color line. And that basically is important because that shows you what's going out of the reservoir. And that's the big story, in my opinion. You can see that we've been between 120% and basically 140% of the level of demand, the number of offers accepted that you'd expect. So there's far more demand than you would normally expect to have happen. That results in the supply demand curve, days of unsold inventory, being a lot lower than you'd expect. The yellow line is the 5-year median, which is from 2015 through 2019, which were all 5 good years. And that if we were having a good year, you'd be right on the yellow line. We're below the yellow line, which means we're having a fantastic year. And by fantastic, I'm not even sure if fantastic is the right word. We're having a very aggressive year. We're having a very quick pace marketplace. You can see we started off fairly normal. Starting at about week number 7, we started to stay level with the speed of the market. And I don't think the market can get any faster. So I think this is really the floor of the market where the market just can't perform any more rapidly. Normally, the market is slowing down. That is not happening. So the vertical separation is getting more. So even though this is the time of the year when you normally slow down, there's no indication that the market's slowing down. What's happening is the market's staying sort of at its limit, and this vertical separation is getting greater as we move on throughout the year. Now we look at overbidding. On overbidding, you have to keep in mind this is delayed by about 5 weeks for the length of escrows to close. And it's pretty hard to see, but right through here and a little bit up here, and then it sort of disappears through here, and then up here, you can sort of see the purple line, which is the current data line. The real takeaway is we've been improving because the dotted lines are the oldest weeks, followed by the dashed lines, and all the solid lines and even some of the dashed lines are basically right here on top of one another. It's not a record month, which is way up here in April of 2018, but you're also no longer really improving. So the market's doing pretty well. There's overbidding, aggressive overbidding, but the amount of overbidding is not getting worse or greater every single week. This chart is getting to be a little interesting. There's been a fair number of media articles about what the rate of appreciation of homes is and converting it into an hourly rate. So I've done that a couple times, and this one's a sort of an interesting one. If we go back 10 weeks, we were at 14.2%. Now you're at 24.1%. So if you give me a 10th percent and call that 10% appreciation to get it nice round numbers of 1% appreciation a week, and if you take the current median price of single family homes in Santa Clara County, which is which is what this is showing the rate of appreciation of $1.7 million, you then find out that if you divide it by 7, divide it by 24, you're made $101.19 an hour, 24 hours a day, 7 days a week by owning the median price of single family homes. So that's just, it's sort of mind boggling that you're making like 6 times the minimum wage by owning a piece of real estate and doing nothing else. Anyway, what this is doing is showing the different micro markets down the left-hand side. It's showing the appreciation since last year's median price, and this is when the median price sort of occurred. That's the median close of escrow. So basically, the first week of August till now, home prices have gone up 24% in Santa Clara County. You can see they've gone up 33% in Saratoga, Los Gatos, 21% in Los Altos, Palo Alto. So the only area outperforming the county average is Saratoga, Los Gatos. East San Jose is pretty close at 21. There's a lot close. The only area that's not doing as well is Cupertino, Sunnyvale at 14%. Now, to say not doing well at 14%, that's pretty insane when you think about it. But there's also, if you look back over the chart, you can see a fair amount of appreciation. San Mateo County has also come up quite a bit. Redwood City is the area there that's probably lagging behind, other than the expensive areas of Menlo Park and Atherton. That's the quick recap. I'll pause, see if anyone's got any questions, and then I will go into it in a little bit more details. Now, since we talked earlier about inventory, this is not a huge drop in inventory. This is going from the MLS that had the highest number of inventory reverting back to my level of inventory. So you can see there's about a 250 count difference, which is pretty significant. I've looked at MetroList, Bay East, and MLS listings, and none of them come close to agreeing on what the inventory is available. It boils down to, what do you consider inventory? The discrepancy appears to be coming soon. Coming soon is a category that is fairly new. It got more heavily used starting in December, and the bulk of the coming soons are do not show with no photography, and none of the coming soons are on any of the consumer websites. I believe a fair amount of the activity is driven by the consumer websites. Therefore, I'm sticking with my old definition. It's got to be on the MLS. It's got to be status 1. It's got to be an active to show listing. That way, that definition is consistent back through 1997. That's why the big drop from 2154 to 1892. Just want to clarify that a little bit. Here is, you're looking at each one of the different areas. And what actually was somewhat interesting to me is looking at Santa Clara County single family homes. That had the vast majority of the discrepancy. So the biggest discrepancy, by far almost all of it, because there's 210 home drop here, and there's 15 home drop in San Mateo County. Yeah, it's half the homes, but even if you double the number of homes, that's only up to 30. If you look at townhouses, it's 20. If you look at condos and townhouses in Santa Clara County, it's 20. So the bulk of the drop is single family homes in Santa Clara County. And that's where I spend a lot of my time looking at the 200 home difference, 210 home difference. And the vast majority are no comments for marketing, no photographs, and do not show. To me, that's really not a listing. So that is why I'm sticking with the definition. Now, the good news is none of this impacts an offer, because once an offer is accepted, everybody reports it as pending. So the number of offers, instead of looking at last week and this week, we look at 1 week and 5 weeks. So you can get a quick jump in your mind on whether the market's slowing down or not. And if you're not good at math, you can come down to the DUI. So in the macro area, for the last week, the DUI was almost 25 days. For the last 5 weeks, it was 22 and a half days. So that would tend to indicate the market was slowing down. And that is the curve we saw earlier where the DUI was going up, even though it's so far below, because 22 days, remember, is a very strong marketplace. I consider 40 to 80 days of inventory to be a balanced marketplace. So now you're half the lower end of a balanced marketplace. And then again, you can see the different areas. The hottest area is Santa Clara County single family homes at just under 19 days of unsold inventory. That means we would sell all the existing inventory in 19 days at the current rate of sales. The slowest area is condos and townhouses in San Mateo County. You can see condos in general are slower slower than single family by about 6 days. That may not sound like a lot, but when you're talking about 20 days, going from 20 days or 21 days to 26 or 27 days, that is a fairly significant slowdown. This is showing the data graphically. I have a bad data point on the 13th of June here, so just ignore it and go straight through, which it makes it a little harder to see the line, but you can see it come out here. You can see that the condos and townhouses are slowing down. You can see San Mateo County is slowing down. And if I was to look at Santa Clara County, I would basically say it's flat. It increased a little bit back here, but it's actually sloping back downhill. So Santa Clara County single family homes is where the demand supply balance is just out of whack, more so than the other areas. Here's the graph, the heat map. The redder the color, the faster the marketplace is. You can see everybody is basically the slowest area is at 41 days. The fastest area, so Cupertino Sunnyvale is at 13 days. Actually, it looks like the fastest marketplace. Foster City is a real small area. Other than that, the fastest big marketplace is sort of the moderate affordable areas in Santa Clara County. Milpitas, North Valley, Blossom Valley, Santa Teresa. I'm actively working right now in the Campbell, Santa Clara area, and at 16 days, it feels busy. I just can't imagine what it is like if you're working in the 12-day market area. Here is looking at the active inventory without offers. So now this is consistent. I went back and updated this. So if you go back and compare this to the handout from, say, last week, you'll see that the blue line has changed. The gold line has not. So now I'm more comparing apples to apples. And you can see that it was increasing and above at the beginning part of the year, then all of a sudden became normal, and now it's below. And again, you only can go to this data point here. Once you hit the purple line, you're into next year. So this is really a solid wall of discontinuity. So you're here and you should be up here based on 5 years of limited inventory. So that's the issue, just the lack of demand supply. And if there was more supply, there would probably be more offers accepted. This is the number of new listings coming on the market. And for the most part, the number of new listings coming on the market fairly well follows the 5-year median. Yes, there's a lot of fluctuation. Again, this is the Labor Day being a week late. So this is high and then you're real low and then you're back up. When you're comparing 1 week to 1 week, there's just a lot of statistical fluctuation, which is why my normal benchmark is 5 weeks, because I want to look at a micro market. This is looking at 2 counties, 2 different types of properties, and you still have that kind of fluctuations. And some of these are going to be holidays, Thanksgiving, Christmas, Labor Day is probably about here. July 4th is going to be coming up maybe right here. So there's the holiday impact, but then there's also a fluctuation just week to week. Now we're looking at the number of new offers that are being accepted. And you can see that we had a drop down in the number of new offers for Memorial Day. And, it jumps out so much. I almost want to go back and look at it, but I think what was going on is because there was so little inventory, when no new inventory came on, there was nothing for anybody to buy. And that's why the demand dropped down more than it normally would do for the holidays. And again, the yellow line is the 5-year median. You can see the vertical separation here with the blue being above. This is your surplus demand. And you can see it's far higher vertical separation than last year. And this is what's causing the fast speed and the rapid appreciation in the marketplace. Now we're looking at overbidding. Again, now we have to wait 5 weeks to get the data because we don't report pending sale price. But basically, you're floating right around the high 70s, low 80 percentile as far as the frequency of sellers getting overbidding. And that is pretty high. That's essentially record high inventory levels. Now in Santa Clara County single family homes, you can see it's up here at 85%. We've never been that high before that I'm aware of. And, I'm a little hesitant to say that. I believe the previous peak, 80.5% of sellers getting more than they're asking. Now you're at 85.0%, so 4.5% higher. And there are some sellers that are always dreaming, and I'm also not counting the ones that sell at asking price. So this is pretty high. You can see San Mateo County single family homes is in second place, and then you can see condos and townhouses in Santa Clara County. It's still a very respectable, somewhere around 74% of the sellers getting more than their asking price. This is the geographical breakdown of the different overbidding. I did not have time to look at it. I do need to look at this it's 96.5%. It's been fixed for one more week. I almost would guarantee I have an equal sign somewhere in my formula instead of letting it float. So it's just been at 96.5% for way too many weeks. But I have no indication that any of the other data is incorrect, and I'm only speculating this is incorrect. It is high, there's no question about it, but I just can't believe it. It keeps being at 96.5%. This is the magnitude of overbidding. This is how high buyers are willing to overpay. And this is 108%, that's 109. So this is right about 108.5% above asking price. That's on average. That includes the few transactions that sell below. In fact, in processing the data, I was noticing there was some sales at like 85% of asking price. That pulls down this 8.5% above asking price. If I looked at the number of only those above, it would be quite a bit higher. This is the distribution on the geographical area. The redder the color, the more overbidding. So real quickly, you can see that the Cupertino, Mountain View, Sunnyvale area has the highest overbidding, and it's at 116.5%. The lowest is Menlo Park here, and it's basically at 103%. It's just almost hard to fathom that we've been at this strong for this long and no sign of letting up. Now, we have seen this graph earlier already, so I won't spend a whole lot of time on it. I do that to show you now just the last 12 weeks. You can see how close together they are. We're missing all the low downs. The whole shift is in the graph is up higher, which is unfortunate, but you don't have any of these graphs, dotted lines way down here. So it's basically showing you that the market has improved, and it really hasn't changed anything in the last 12 weeks. So the improvement was from week 20 through week 13. Those weeks would have been down here, and then it came racing up. Okay, on to sale price. This is what a lot of people like to follow. Here, what I'm looking at is the 10 percentile, the 50 percentile, or also the median and the 90 percentile. So now this allows you to sandwich the price ranges. So you can see the price range of any given geographical area. The color is assigned by the middle number, the median. The first number is the 10%, median, and 90 percentile. So, let's just pick Campbell for an example. Campbell, Santa Clara, Willow Glen, Cambrian. The cheapest 10% single family homes are about $1.3 million. The most expensive are about $2.4 million, and the median is at 1.7. One of the reasons I picked that is Cambrian, Campbell sort of in the middle, and 1.7 happens to be the median for the entire county as well as for that micro market area. It just gives you an idea of the range of the different areas. So there's $1 million range in the Campbell, that one area. 80% of the homes are priced within that $1 million or sell within that $1 million. Now what we're doing here is we're just looking at the table, and June data is not available until July the 5th, and I collected on the 6th because you need to get to midnight on the 11:59 on the 5th. So here we're just taking a partial month. We're going up through the 18th, and this is actually the date I gathered it on. So just for disclosure, I goofed up last night and I put in Thursday's date instead of Friday's date. So these numbers are only through Thursday instead of through Friday. One day is not going to make a huge difference. But what you can do now is you can start comparing this data for data that normally will become available in July. So the median asking price really hasn't changed at all since last year, even though the median price of what's selling is quite a bit higher, and the median price of what's sold has gone up $300,000. It must be just more of it because the low end is not on the market longer. So it has to be just that there is more of the low end market that keeps the median price of what's available on the low side. You can see the inventory at 750. That is the lowest inventory we ever had. In 2017, we had 800, so we had almost 10% more inventory. That makes me question, are we going to have any slowdown this year like we normally do in price and appreciation? Are we going to have a repeat of 2017 when you had a second wave of appreciation starting basically mid-July? A lot of people, including myself, typically say August. Is that what we're in for? There's no way to know, which is the sort of the exciting thing. The market is cooling, but it is so superheated, I'm not sure there's going to be any price drops or even price leveling off, frankly. Here is your average days on the market, 14 and 8. If you go back and look, those are the record low numbers. If you look at sales per day, almost 41, you do have higher numbers, but you do have to get back to 2011, and then you have to get back to around the 2002, 2003, 2001. The market has in general been slowing down as far as the volume of sales and the magnitude, the number. And that was part of the motivation for the real estate industry for passing Prop 19. Whether you like it or dislike it, it's now the law of the land until we change it yet again. That may be spurring some of this supply. They were expecting it to be more supply. It almost seems to be stirring up more demand, but that doesn't make a whole lot of sense. And it could be all COVID demand, which is starting to not make a lot of sense. If this was COVID related demands, unless people have permanently shifted, which is possible, and aren't really going back to work and they need the more space, it's not a shelter in place relationship anymore, because that's basically over at this point. Now, if you look at the number of sales at 1,420, you can see that you have to go back to the same years, because that's the same as the sales per day. It's just the total volume. And this is volume over the last 35 days. So you're comparing apples and apples. You're comparing as close to apples as you can, because this is 35 days starting on June 1st. This is 35 days ending on June 17th. Get down to the square footage of the home, and then you get down to closings. I'm not following the days on market anymore, just because the speed is really determined by the sales, and it just frees up a little less data that I'm collecting. You finally get the overbid price. And just for noteworthiness here, this 7 and 4 is artificially low because the MLS froze the number of days on the market because of COVID. So those numbers, I should have a line through them. This at 110.1%, when you look, is a record for this time of the year. 107.8 was the previous record. The frequency of overbidding at almost 85% is an all-time record. The previous high for this time of the year was 79%. Here you're looking at the price range, and now you can see we've hit $1.7 million for the median sale price, and we've closed 1,444 homes in the last 35 days. And that's it. So I will pause and see if there's any questions. And as people are getting ready to ask questions, the green is the root URL. You add the year code to get to the live meeting on Saturday morning at 9 a.m. You add the word handout and the 8-digit year, month, day code to get the handouts, which were up by the quarter to the hour, like I try to get them. And to get to an archive to revisit it, you just add in the year, month, date code. So with that, I am done, and see if anyone's unmuted for a question. Seeing lines through all the microphones, I'm done unless someone interrupts me. Have a nice week, everybody.
You too.
Thank you.